We're here with Professor David Yermak, a colleague at NYU Stern, who chairs the finance department and also leads our fintech specialization, and is also our first three-time guest. So congratulations, a nice moment for you.
It's an honor.
Yeah, what a thrill, right? So David is our resident expert on crypto and blockchain. Give us an update on what's happened in the market over the last 30 or 45 days.
You've seen a general rise in the market. Bitcoin is now flirting with the $10,000 market price again.
What was the low? It went down to 6,000 or 5,000?
Yeah, it's risen about a third since earlier in the year. It's, you know, if you had bought it, say, at the end of January, you have a really nice profit on your hands for the last 3 months or so.
Yeah.
And we've had a lot of regulatory activity that has gone on in Washington with the SEC thinking about exactly how big of an umbrella they want to try and fit over this space, how much of it is really covered by the securities laws, and something of a turf war with the CFTC, which wants to regulate these things perhaps as commodities under certain circumstances. So regulatory clarity has been a long-sought goal of almost everybody in the space, and we're seeing at least some movement in that direction, but it's far from certain what the courts will think of this when inevitably there's litigation, and ultimately Congress will probably end up having to write new laws to cover what's really a new type of property.
And we also saw Goldman has made some big announcements around crypto, right?
They intend to trade some private futures that will be a type of derivative, and I think really many of the big asset management firms are getting enough inquiries from their clients that they're looking for ways that they can offer these products without going over tripwires on the compliance side that might implicate some of their other product lines. But I think you're seeing a demand-led entry of some of the bigger players on Wall Street who are trying to meet the needs of their customers by offering these in different portfolios, different derivative forms, and so forth.
And probably the biggest news was Buffett and Charlie Munger. And how do they feel about Bitcoin?
They don't like it, and they've been very consistent over time at finding increasingly pejorative language. At the Berkshire Hathaway annual meeting, Buffett said that owning Bitcoin was rat poison squared.
Squared, that's the key.
And rat poison squared. And Charlie Munger said that trading cryptocurrencies is just like dementia. And they don't see much of a role for this. Buffett has always said that he doesn't like to invest in what he doesn't understand, and it seems that he's sticking to that with the cryptos.
But they're comfortable commenting on what they don't understand,
comfortable
right?
trashing it.
So talk to us, we were talking a little bit about some of these new coins and what some of the developments there.
One of the more interesting classes are the so-called stable coins, where people are trying to create coins that replicate real assets or real currencies in the economy. So there's something called Tether that's been in the market since the middle of last year, and a Tether is supposed to keep a fixed value of $1 per Tether. And there's another one now called Basis that has a similar objective. It wants to be stable, really as a substitute for the US dollar, but a somewhat different trading strategy in the background that's meant to keep the value stable.
So buy it when it comes below $1, sell it when it goes above $1, and just keep it. It's almost like the Bank of England trying to support the pound at a certain level.
It's exactly what central banks do to try to peg the value of their currencies to one another. So you may remember a few years ago the Swiss central bank put a ceiling on how much the Swiss franc could rise against the euro. For years, the Hong Kong central bank has pegged their currency to the US dollar.
Doesn't that always end poorly?
There are famous episodes like in Argentina in the 1980s and 90s. They ran what was called a currency board to try to fix the Argentine peso to the dollar. Eventually you run out of money.
To support it,
Yeah, if you make a commitment that we'll buy as many as we need to, sooner or later you need to buy more than you can afford, and these things tend to collapse and end rather badly. Now, the guys at some of these crypto coins, and there's actually quite a few of the stable coins now, they claim to have algorithmic strategies that will execute themselves automatically, and I think these things often work under normal market conditions, but when conditions get extreme, there's a lot of volatility, a lot of underlying movement in the market. That's sort of when you need the stability the most, but when people are least likely to be able to afford it. So it's far from clear. We'll need a long period of time to see if these things really can hold their value, but this is the marketing pitch that they see a need for these kinds of tokens to provide liquidity and just a benchmark for other things to go against in the crypto economy. And so there's been a lot of enthusiasm for this. Some people are trying to tokenize gold, or you could think about doing this even for shares of stock or many other currencies besides the US dollar. So this might turn out to be an interesting market space where you can replicate existing assets but get out from under the ordinary regulatory burden that comes with owning and distributing them to customers.
So if the interesting thing you said there was that it would be like the dollar, but skirt the regulatory hurdles you get from transferring dollars. Does that mean you don't have to report to the IRS, so there's no red flag when you deposit $10,000 somewhere else, or you send $1 million offshore? What does that mean?
What your obligations are to report is very much a gray area, and there are lots of different points of view. I think there are existing laws that certainly could be interpreted in one country or another that you would have reporting obligations. But I think the attraction in many of these assets is that either people believe that the authorities can't see them or won't take an interest in them, or that in fact they're so different from the underlying thing that they're trying to mimic that maybe the same obligations don't kick in. There's a lot that the regulators are going to have to do to catch up with this. You know, it's very challenging, not just in Washington, but in every capital around the world, that you have a new form of digital instruments that just don't fit well into the securities laws or the banking laws or the tax laws. And even if you could write laws that capture these things, the way you chase them down in these virtual forms that they take and the way you might enforce laws against them and punish the people in charge, it's very difficult to see how that would work the same way, because this stuff doesn't exist physically. It exists in the cloud in virtual space. So I think if you're looking to move money around the world and not see regulators knocking at your door when it exceeds $10,000, this is one alternative that might attract some people. Could also attract terrorists and all kinds of other people who want to move money without being detected.
But isn't it one of the sales points of this thing that it actually should do away with crime because it's all ledger-based and should be pretty traceable?
I think in theory this is correct, that you've actually got a blockchain that is a record of every transaction ever, and this makes it really quite hard to hide, that your whole history is there. Even if today they don't know what you've done or who you are, they have all the time they need to kind of try and invert this and figure it out. But I think you're going to see an arms race between cryptographers who are selling anonymity in the form of blockchains that have super encryption and these zero-knowledge proofs and various other features. And you'll see consulting firms go into business to try to unravel these things and deliver up to the authorities who really is controlling these wallets and who's really moving the money. I think, you know, clearly you've already seen the opening of an arms race in this little corner where some groups think you can use this technology to hide. Other groups think it's kind of a trap that the government can lure people onto these platforms and then see exactly what they're doing. There is kind of a high road and a low road. You see a lot of people doing voluntary compliance and just putting up their hands and saying, we agree we're securities, you know, show us which box do we check.
Along those lines, initial coin offerings, you say there's a flight to quality.
There have been more than 2,000 ICOs since the beginning of last year. Half of those never got off the ground, you know, and so there's a lot of them go very quickly to zero. But some of them have been very successful and raised hundreds of millions of dollars. And they are now investing this money to develop platforms that may eventually deliver things like decentralized storage that is in great demand. So of the tokens that are out there, some have been, you know, very brazenly non-compliant. You know, they've ignored the law, and some of them even just kind of look like Ponzi schemes on their face. But others have done quite the opposite, and they've tried to put structures in place that resemble what venture capital and other forms of entrepreneurial finance have done.
Disclosure, risk, all kinds of, basically, almost like putting together a prospectus.
Yeah, it's like a prospectus. They call it a white paper, but the structure that people are using that seems to have the most regulatory credibility is called the SAFT, the S-A-F-T, or Simple Agreement for Future Tokens, which resembles something called the SAFE, which is for future equity, that has been used in venture capital for some time. I'm not sure if the SEC ultimately will give this its blessing, but I think it represents a sincere attempt by the industry to get on the good side of the regulators. And often it's really voluntary compliance, that people who are trying to get credibility for a new type of asset, they find it in their interest to work with the regulators, and to seek the high ground and to try to pay their taxes and disclose everything that should be disclosed, because in the long run, people probably don't want to invest in something that doesn't have that kind of credibility. So this is a very early stage of a market that is, not even maturing yet, but maybe going through adolescence. And you are seeing segmentation, and there are people going for the high ground and people going for the low ground, and a lot of confused people in between. But I think one thing that's true about these coins, the tokens, they're not going away. This is a real innovation that's quite interesting, and people are being able to raise large sums of money rather quickly.
That's a statement right there, because at one point about a year ago or 6 months ago, it felt like there was a non-zero probability ICOs could just get shut down as pure fraud.
Right.
You think it's here. You think it's a financing vehicle that is going to be around for a while.
And like I said, there have been 2,000, and well over half have been worthless rather quickly.
What percentage are not, if you use the term broken IPO, what percentage are not broken ICOs, where they actually have worked as financing vehicles and they have some value 3-6 months post the issuance?
At this point, I would say about 20% based on data that I'm working with. Now, that's not to say that many of those 20% won't themselves fail in the next year or two, because this is characteristic of all startup businesses. And I think the right benchmark is not that you should expect all of these to return a profit. These are very risky ventures. Think about, of all the restaurants that open in New York, how many are still open in a year? What's the failure rate for new restaurants? That's really the kind of benchmark you want to think about, is for startup businesses.
Yeah, or even, you're exactly right. It's not, the benchmark isn't the percentage of successful IPOs, it's the percentage of venture-backed companies, even going downstream into angel, where maybe it's 1 in 10 or something like that.
IPOs are the ones who get, all the way to the 8th inning.
Most of them are already winners. Yeah, so if an ICO, or talk to us about, can an ICO just be a financing vehicle, or is it strictly the domain of companies that are building something related to the blockchain? So you had a great company and wanted to avoid venture capitalists. Could you do an ICO, or does it have to directly be linked, does a capital raise have to be directly linked to innovation around the blockchain?
That's really what an ICO is something linked to a blockchain, because it is a token giving customers the right to use the product once it's completed in the future. So it's a way to raise money from your customers rather than
a Kickstarter thing, right?
Yeah.
Yeah.
And it's really a new channel that historically people raise money by selling ownership that we call equity, or maybe from borrowing it from a bank, which we would call debt. But this is not debt, it's not equity, it's a new type of financing where your customers invest, and if the value of being a customer goes up, they will profit as well. But it's really the utility of using the token to access whatever the service is that is the source of the value. It's not a dividend or an interest payment or even a capital gain necessarily.
No ownership, no governance, nothing like that.
Yeah, the definition of a security from an economist is you get cash flow rights, like dividends, and you get governance rights, which is typically voting. And you don't get either of these with a token.
Why wouldn't Tesla do this? Instead of taking cash upfront, why wouldn't Tesla have a coin that says, for this coin, this is the Tesla Model 3 coin?
I wouldn't rule it out, and you do see business models where people pre-sell their product before something is built. So cruise ships will sell tickets to the cruise before the boat is launched. Football stadiums are built this way all the time, where personal seat licenses are sold before the stadium is constructed. And you're tapping into your customer base as a source of finance in exchange for them getting the gain if the experience of being a customer turns out to be more valuable than people expected. So, why doesn't Tesla do this is kind of a good question for Elon Musk.
But that's not related to the blockchain. That's just a financing vehicle. So you do think we'll see coins that aren't directly related to building out the blockchain?
The blockchain is where these things are hosted and traded. And I think
that's the exchange.
Yeah, one thing that you need is some controlled scarcity. So most of these tokens are created by way of smart contract, where you can make a credible position or credible commitment through the software that you won't create more tokens and dilute the ones that are already out there. So in terms of a football stadium, you don't want more personal seat licenses than there are seats. And in terms, if Tesla were to do this, they'd need to make some commitment that there wouldn't be more Tesla coins than cars. And one way to do that, in fact, is to host them on a blockchain where the issuance protocol is very transparent. And so if they actually tried to dilute the market, you would be able to see it happening and complain.